What's going on, guys? Welcome back to the channel. In this video here, we're doing a follow-up analysis on NIO, and it's been a while since I covered this company. So loading this up in the stock research tool built by yours truly, and if you want to get your hands on this software, stay tuned. It's an app that's coming out for you, my viewers and subscribers to use. We're grading this company a 5 out of 10. Now, this is a 5 out of 10 on my financial evaluations section here of the software. Now, what this category or this portion of the software does, it takes a look at the balance sheets, the cash flow statements, and the income statements and grades it based off of different metrics that the company provides. And we'll figure out what NIO is doing right and what NIO is doing wrong. So with NIO, we are ranking this 5 out of 10. That means 5 of the categories we're doing something right, and those categories are the current ratio, the debt to equity, the 5-year net income growth, as well as the free cash flow growth and revenue growth. Current ratio, it's over 1.5. We have that no problem. Our debt to equity is 34%. We want to see that number underneath 50%, and we have that very easily. As well as our net income growth has been growing. Our free cash flow growth has been going up. So free cash flow has been going up, as well as our revenue growth has also been going up over the last 5 years. These are some pretty solid numbers, folks. These are the categories that I like to see the most being at least exercised, because at least I know that the business and fundamentals are improving. They're actually moving product. Now, where they're not gaining points from us are in some very important categories as well. Our 5-year PE average is somewhat of a wash because the company hasn't been public for that long. So just to keep that in mind, folks, we're looking for a 22.5 and under. We don't have that. Currently, we're at negative 44.87 in our trailing 12 months. Now, that's not good because that means they're not really making any money, right? So that point is a wash. Return on equity average is 1.95. We want to see this number 15% or higher, folks, as well as we don't have much EPS growth. Actually, we are in the negatives for our EPS growth. One category that's really bothering me about NIO is their share dilution. Look at this, folks. We're ranking this obviously a 0 because over the last 5 years, or however long this company's been public, 41% of shares have been they've increased their shares by 41%. That is a massive number. That means that you, as a shareholder, are owning less and less of the company. We don't want to see that, folks. We want to see that number decreasing, or at the very least staying the same. So 41% is absolutely horrendous, but it makes sense that the debt to equity ratio is as low as it is. I give them a point for the debt to equity because they're not taking on debt. They're building the business through equity, and that equity is their shares. And rightfully so. Take a look at this. We go back to the stock research tool here and take a look at this. This huge run up of price, as low as $1.55 in October 2019, hitting a high, let's say $59, or somewhere around there, say like $60 or so in 2021. That's a huge run up. So listen, if people like your company and they like your shares, why not just keep issuing out shares, right? That's what they're doing. So we don't want to see that. We want to see that number decreasing, or at the very least staying the same. Now, our return on invested capital average is sitting incredibly low in the negatives. We want to see this number 10% or higher, folks, and we don't have that either in the 5-year average or our trailing 12 months. So that is also somewhat concerning. So here's the thing, folks. 5 out of 10. It is not a great score. It's not a great score from the fundamentals of this company. However, the price has been going down, and now we're currently on a little bit of an upswing here, sitting at 22.60. Now, personally, I like to see when companies have somewhat of a questionable fundamentals, like as we're seeing here with NIO, I like to see that price decreasing, because then it's going to bring it down to a more fair value. So the other portion of my software here, we're going to go into a price analysis. Now, what this price analysis section does is that we're able to, let's say, factor in, let's say, 10 years or 20 up to 20 years of growth for this business based off some numbers that they've provided us, and we can make assumptions. We can do 3 different assumptions: conservative, moderate, and aggressive, and then discount it back to figure out what this company should be priced at today. I'm going to fill these boxes in, and then we'll talk about it in just a quick second. Okay, folks, before we just jump into what I just did, if you're enjoying the video so far, hit that like button and subscribe button, and make sure you share this video with a friend if they're looking to analyze NIO as a potential investment, and if they're looking to build a process in investing. So take a look at what I did here. If you're new to the channel, I like to stay conservative with my numbers and try to make the most amount of sense of what we're given. So with NIO, here's the problem that I have. We have obviously crazy revenue growth, so I discounted that to try to be as conservative as possible. So 20, 22, and 24. Now, where it gets a little bit fishy is that with our profit margins and free cash flow margins, we're only shown negative numbers. So this is me speculating, folks. This is me speculating on what the future might bring. You know what? It doesn't make sense to do 0, but I'll do 3 as something on the low end. Now, you might say, wow, Leo, that's incredibly low. But here's the thing. I'm going to go 7 instead. I'm not going to do 10. But I'll do 3, 5, and 7 in terms of profit margin and free cash flow margin. And then price to free cash flow, I'm going to discount that to be underneath 20, somewhere that's a healthy range, as well as a PE ratio that's also in a healthy range that's underneath 22.5. This is heavy speculation, folks. I don't like being in this realm because I want to see the company first prove themselves at least a couple years that they're able to hit some positive numbers. So we run that through, we calculate it with the app, and we'll figure out what that equates to. So take a look at this, folks. If you believe that NIO will grow at 24% revenue per year with a 7% profit margin, keep in mind, folks, this number has not existed yet. It's a buy. $26.12. However, we like to pay more attention to our conservative and moderate because this is something that may happen first rather than our aggressive categories. Because look, we don't have any positive numbers. Our average calculation comes out to be 15.72. We're really just speculating. We are really truly just speculating. And with the EV space continuously growing, it took a while for Tesla to actually cover some ground. Take a look at how long Tesla has been on the market and when they actually decided to make a when they actually made a profit. Tesla was on the market for over, let's say, over 10 years, and then it was just 2019 is actually when they decided to, or when they finally made a profit and became a profitable business. NIO is not there just yet. So what does that mean? If you are willing to go for the long haul with this business, it might take a long while. However, we have to assume what those numbers may be. Currently, without them showing a positive profit, we will never know. This is speculating, so you may just be overpaying for this business. As well as there's a lot of other things that they have to get underneath their belt. So for me, looking at this company, I can't really put a fair price to pay for this business because they haven't shown me anything. However, I can go based off my financial valuations and say, I don't like this score. I want them to get their return on invested capital under control, and more so, get their share dilution under control and stop issuing out so many shares and instead buy back shares to reduce the outstanding share count. As soon as I see things like that and this becomes a higher score, then it may be something to take a look at. But until this company's been on the market for quite some time, and for me, that number has to be around 5 years, I am avoiding this business. I'm avoiding this business because they haven't proven themselves just yet. I'm not saying they're a terrible business. I'm not saying that at all. But they need to prove themselves in order for it to be worthy of my capital. They have to show me that they're able to hit home runs, not that they were able to just crush one game in softball. You know what I mean? That's the one thing. I want to see consistency. That's what I want to see. And I don't have that with NIO. And if you want to get your hands on the software, folks, stay tuned. It's becoming an app. We have a lot more features. As I said, we have cash flow statements, we have income statements, balance sheets. There's so many different things that are going to be integrated into the software. We're just getting started. But those are my thoughts on NIO, folks. I'm avoiding this company once they are more so profitable. It needs to be on the market for 5 years or more. I want to see some improvements. I want to see their share count decrease and buying back shares, and then we can talk about it. But for now, I'm avoiding it. That's the video. I'll see you in the next one.